We sit here, Richard, about 13 years after '08. And now the House of Lords are worried about QE, quantitative easing. The best person to talk about that is the guy who first termed it. That was you. Why did you term it? What does it mean? And why are the House of Lords now worried about it?
Yes, well, I proposed this monetary policy, a new monetary policy, in 1995 when I was chief economist at an investment bank in Tokyo, because I predicted, and I had already predicted since 1991 when the top banks in the world were all Japanese and Japan was supposed to take over the world. And I put out my forecast that actually no, Japanese banks were going to go bust.
But that must have been...
Japan was going to move into the biggest recession since the Great Depression.
But that must have been the most contrarian call at the time, insofar as everyone was saying that all the land under the Imperial Palace was worth more than all of California combined.
Yes, I mean, most of the strategists were recommending in the early 90s, when the Bank of Japan was lowering interest rates for the first time, to buy Japanese stocks. Yes, they'd fallen a bit, but they're lowering rates, and the official story, the interest rate story is, when you lower rates, this is good for the economy, it's good for stocks, so buy. And I was saying the diametrically opposite, sell. In fact, I was still a student at Oxford in 91 when I put out that paper as an Oxford discussion paper. I bought put options on the Nikkei, which worked because they were heading further down. And so then when I was chief economist in 95 in Tokyo, I proposed a policy to get out of what I was expecting was really going to happen now, a massive, complete banking crisis.
Right.
And it's therefore a tool that was designed to get out of banking crises quickly and help the economy recover very quickly. But of course, it has to be implemented in the right way.
Right.
And the definition of the tool is really more or less, well, different from what they turn it into.
Right.
The key principle is, again, credit creation. I'd already proposed my quantity theory of disaggregated credit, or the general quantity theory, because the money supply is created by the banking system through credit creation. When banks lend, they create money out of nothing. That's how 97% of the money supply is created. And the important question is, what is the money being used for?
Right.
And that will determine everything else.
Right.
It's a crucial decision, because if it's used for productive purposes, implementing new technologies, increasing productivity, you will get economic growth without inflation, which is really what we want. But if banks create money and it's used for unproductive things, that's when you get into trouble. There's two possibilities. One is for consumption. Clearly, you get consumer price inflation because you've got people consuming more, but there's not more goods and services. That's perhaps more understood. But what's usually ignored is when banks create money and it's used for purchasing assets. Because it's money creation, bank lending is money creation, you are printing money, pumping it into asset markets. What's going to happen with asset price? Of course, it's going to rise, and they're going to rise. And everyone will make money, including the banks and the borrowers. So it looks, and for quite a while, it looks really good. But it is from the beginning very clear that it's unsustainable. And if it is big enough, and often it is big enough, then it will lead to a banking crisis. And this is, of course, what happened in Japan in the 80s. Massive bank credit expansion. We can perhaps mention why this happened. This is an interesting question. But once you have this, then it's clear you are setting the stage for a big banking crisis, and that could turn into a long recession. And my policy then came in to essentially prevent this long recession and very quickly get out of it. And it's very easy suggestion. So the true definition of quantitative easing is to quantitatively increase credit creation in the economy for GDP transactions.
Right.
Now,
but that's very targeted, isn't it?
Yes,
and what
exactly.
actually has happened with central banks across the world is a scattergun approach.
Exactly.
And actually, wherever you foresee a problem, whether it be banking through to a pandemic, let's have another go at QE.
Exactly. That's been the problem since 2008. The credit creation has not been targeted at those transactions that actually help the economy and contribute to the creation of wealth and lead to high, sustainable, equitable, non-inflationary growth without crises. Instead, they did more of what really led to the crisis in the first place, which is bank credit creation for asset purchases. And that clearly makes things worse in the long run, while in the short term you think, oh great, we're all doing well, we're earning money.
But it's the drug addict analogy, isn't it? One more hit, or Pringles if you like. Once you pop, you can't stop, right? Because there is a law of diminishing returns. You will juice all these asset markets. Asset prices will go through the roof. The financial sector will do very well, thank you very much. The real economy, well, here we go.
Yes.
We've been starved of any investment.